Hello everyone, welcome to this video on the payroll cycle in accounting. In this presentation, we will understand how salaries are processed, recorded, and paid in an organization. Payroll is not just about paying employees, it also involves accounting, controls, and compliance with laws. By the end of this video, you will clearly understand each step of the payroll cycle along with examples and journal entries. Now let's start by understanding what the payroll cycle actually does. The payroll cycle records and controls all transactions related to employee compensation. This means everything from calculating salaries to recording them in the accounting system. One of the main objectives of the payroll cycle is to ensure that employees are paid accurately and on time. Even a small mistake in payroll can affect employee morale and trust in the organization. At the same time, payroll accounting ensures that salary expenses and related liabilities, such as unpaid salaries and taxes, are recorded correctly in the financial statements. This is very important for accurate financial reporting. Payroll is considered one of the most sensitive cycles in accounting because it involves cash payments and strict legal requirements. Errors or fraud in payroll can lead to financial loss and legal penalties. Finally, the payroll cycle does not involve just one department. It includes employees, management, HR for hiring and authorization, the finance or payroll department for processing, and government authorities for tax and statutory payments. The payroll cycle refers to all activities related to paying employees for their work. This includes calculating salaries, making deductions like tax, paying employees, and paying government authorities. From an accounting perspective, payroll cycle creates expenses and also creditors such as salaries payable and tax payable. Because payroll involves cash and legal obligations, it is considered a sensitive and high-risk cycle. The payroll cycle begins even before salary is paid. It starts with hiring. HR department authorizes who is hired at what salary and from which date. This step is important because only approved employees should receive salaries. If this control is weak, companies may end up paying fake or unauthorized employees known as ghost employees. Once employees are hired, their attendance or working hours must be recorded. This could be done using biometric systems, timesheets, or attendance software. Attendance data is very important because salary calculations depend on it. For example, overtime hours increase salary while unpaid leave reduces it. Now comes the calculation stage. First, the gross salary is calculated, which includes basic salary and overtime. Then deductions are applied, such as income tax or social security. After deductions, we arrive at the net salary, which is the actual amount paid to the employee. This is where accounting entries are passed. The company records the total payroll as an expense. At the same time, liabilities are created for amounts not yet paid, like salaries payable and tax payable. This step ensures expenses are recorded in the correct accounting period even if payment happens later. Next, the company pays net salaries to employees usually through bank transfer. Once payment is made, the salaries payable liability is cleared. This step involves actual cash outflow and is usually done on a fixed payroll date each month. After paying employees, the company must also pay deductions to the government. These include income tax and social security contributions. These payments must be made on time to avoid penalties and legal issues. Once paid, the related liabilities are cleared from the books. Every payroll transaction must be supported by documents. Examples include employment contracts, attendance records, and payroll registers. These documents provide evidence and help in audits. Accounting records such as journals and ledgers ensure payroll transactions are properly recorded. Payroll affects all three major financial statements. In the income statement, salaries appear as an operating expense. In the balance sheet, unpaid salaries and taxes appear as liabilities. And in the cash flow statement, payroll payments appear as operating cash outflows. Strong internal controls are essential in payroll. Different people should handle hiring, payroll processing, and payments. Salary changes should be authorized and reviewed. Regular reconciliations help detect errors or fraud early. If controls are weak, payroll errors can occur. Common risks include overpayment, underpayment, or paying ex-employees. Incorrect tax calculations can lead to penalties. Because payroll happens regularly, small errors can add up to large losses. From an auditor's point of view, payroll is a high risk area. Auditors check whether employees actually exist and whether salaries are accurate. They re-perform calculations and review payroll trends. Proper documentation and controls make audits smoother and faster. To summarize, the payroll cycle starts with hiring and ends with payments to employees and authorities. It involves expense recognition, creditor management, and cash payment. Strong controls reduce risk and ensure compliance. Understanding payroll accounting is essential for both exams and real world accounting. Thank you so much for watching this video. If you found this explanation helpful, don't forget to like, share, and subscribe. If you want more videos on accounting basics and auditing, let me know in the comments. See you in the next video.